just make sure everybody has participation. So welcome to our webinar. Just to give a little bit of a frame of reference, if you're unfamiliar with Infusion and the Infusion family of companies, um, we have really nice national breadth. So our perspective is um, most of the states in the country. Um, the primary data that we're going to talk about today comes from over 364 banks and credit unions. Our our quick analytics family of company has a perspective on every bank and credit union, but the real specific granular information on the intersection of specific tactics and campaigns and responses is really informed by almost 400 banks and credit unions, over $25 billion of balances specifically tracked to tactics and campaigns, and then over $14 billion reference point. So, yeah, awesome. Thanks for participating in the poll. We'll put that up. But looks looks like new to bank acquisition is a huge priority. We see that when we're talking about deposits as well. So new to bank acquisition, retention is certainly a key improvement, and then not as much focus on NIM and pricing, which makes sense. And then rounding out is the just enroll loan growth and relationship growth. So I think we're going to great some great information to share given those priorities. Um, Drilling in a little bit more, the types of KPIs that Infusion helps generate for clients is, interestingly enough, with the priority on new to bank acquisition. We look at macro stats like how is your just total new to bank relationships changing year to year, and we've seen results where banks have been able to nearly double those with obviously a strategic change in focus and priority and resources. But then we also look at what's a cost per account, what is the impact on cost and funds and NIM, and then of course payback compared to results. And so really this session this morning is focused on three major subtopics of strategic loan growth. And so we're going to start with just some big picture trends. What are we seeing at a macro level? That'll set the stage. And please do chime in. So we'll try to monitor the chat window. If you have questions as we go forward, just chat those as you're thinking about it, and we'll get to them along the way, or certainly by the end if we don't cover them. We want these sessions to be as interactive as possible. You're investing time to be with us live, and we appreciate that. And then the next big topic is strategic loan growth. So what is a systematic process? So going back to the title of the talk, in terms of best practices, what does it look like to actually create a systematic process to drive an outcome? And then ending that with some case studies on, okay, when you put in place that process, what does the result look like? So from a big picture, and I'm pulling this off of our quick analytics database that comes from the sister brand to Infusion. And so when we look at median kind of trailing 12 months loan growth, so basically year over year loan growth, what we're seeing is certainly a deceleration across the industry from 2022, right? We all know why that was the case and what's happened. But then with rates dropping in Q3, we don't have Q3 final numbers from the industry yet, since the quarter just ended a couple of days ago. But we definitely expect to see demand pick up as rates drive. What's really interesting, though, is when you look at what institutions have been doing is all the way through that sort of decline in demand, The banks that have been consistently focused on relationship loan growth have seen pretty consistent response rates, other than a little bit of a dip in Q1 of 2025, but really consistent in the 1 to 1.2% booked loan account response rate. And so that just speaks to that there are opportunities there for quality relationship expansion, and then certainly relationship growth and retention, uh, where there's an appetite, where there's a desire to do things perhaps differently than have been done before. And so, um, and I should mention that my perspective is informed by before Infusion, where we work with hundreds of banks. I was the chief marketing officer at Hancock Whitney, and before that, for what is now First Horizon. And so, the perspective as a banker and as a partner to banks is I've seen over and over again that creating a predictable, profitable, or organic loan growth generation is possible with the right discipline. And so, whether or not those priorities are relationship expansion to drive growth and retention, or new to bank relationship, it takes that discipline. And so, when we look at the macro picture of what that discipline looks like, it really is a continuous improvement process, right? It's a continuous process. It's not a start and stop process. One of my favorite banker friends called it, it's not sort of random acts of growth, right? It's let's start with a systematic understanding of what is possible, what are the risks, what are the gaps, and what are these opportunities. Have that data drive that feeds into a disciplined planning process, and then we run campaigns. So campaigns is a great way to describe running tactics of combined kind of marketing and sales activity. But we're making a systematic, specific effort to drive demand, or to capture demand, track that result, that feeds into it, and then it feeds right back into an annual systematic look. And so we're taking a big picture, we're doing things, we're tracking, and it's a continuous feedback process. And so that's what we mean by creating a predictable, disciplined process. And then we'll unpack that a little bit more as we go through. And so, when it comes to assessing loan growth, I mean, there's really some practical business questions. This doesn't necessarily require like big data, although tools certainly help with this process. But it really starts with fundamentally asking the right questions. So, key questions like, how penetrated for credit needs are my existing customers relative to peers, right? I may know what my current penetration is in my deposit base, but then do I know, is that good or bad? Or is that normal? And so, when we think about particularly attrition risk, if we don't communicate to our current customers about the loan solutions we offer, we're making them vulnerable to to the competitors who are talking about it. And these days, of course, the competitors are even more varied than, everything from fintechs to national banks to everything else. Number two would be, what are the relatively lower credit risk growth opportunities to prioritize, right? So we're thinking about the full slate of opportunities. Where am I going to get the best bang for our buck? That can be informed by understanding granular information about where those pockets of attrition and growth further enriched by peers. And then number three, increasingly there's a question of, where am I perhaps not seeing the growth? Where am I underserving areas that the regulators are paying attention to? Of course, that's waxing and waning with those things, but it's where do I need more strategic growth outside of my customer base for either regulatory or asset growth perspective. So these are real practical questions. Now, it's a little bit like any kind of competitive activity, easy to say, harder to do. And so, if we're going to get somebody to buy things with us, those questions translate into a framework that says, okay, the financial needs that an individual has, there's an intersection of active credit. So someone who's interested in borrowing, there's an intersection of other financial needs, right? That there's an intersection of what's their savings needs, what's their transactional needs, and every single customer that the bank has will have a certain level of relationship. So they have their needs, and then which banks are satisfying those needs. And so we bring to bear, or one of the perspectives is understanding those needs as a start, then using data to say, okay, what is every individual's capacity and propensity to buy for a credit need? Obviously, there's a kind of the classic credit score idea of somebody with a 570 credit score may have all the interest in borrowing but none of the ability or capacity. We don't just have to rely on credit scores. There's other data that indicates someone's capacity and propensity for doing business with your specific institution. And then awareness is taking that data that kind of is the potential energy, if you think about it. And so when we take data and we communicate our solutions to those needs, we create awareness around the solutions and needs. That's what takes to take somebody down that buying path. And so we apply this framework into that gap analysis perspective. And so, for example, we can benchmark where a bank is, where a bank's customer base is on these. So, for example, this particular example we pulled out of some real bank data, the bank had a 20% growth opportunity by just moving existing customers to the center of that circle. They had a 30% growth opportunity in the high deposit and active borrowers. So in other words, if they got more of their existing high deposit customers to also actively borrow, they could see 30% growth. And that has a really powerful um, kind of twin benefit, which we'll talk more about, right? I mean, high depositors, of course, have different levels of propensity on borrowing, but they have really attractive credit characteristics. And then further down, you can see there's a 21% growth potential to just get up to the peer average in terms of existing customers that are just doing loan work with the bank. So this just highlights some very high level opportunities of uh, satisfying existing customer needs up to the level of peers. Um, Deposit concentration has a really interesting uh, intersection with credit growth because if you look at the top chart, so this chart is looking at stratifying by the level of deposits with the bank, and so the top row is those customers that already have $250,000 with the bank. Now you might think, okay, if they've got $250,000 with the bank at an average of $455,000 in deposits, those are not great credit opportunities. But because we benchmarked that in terms of what is their level of credit. So 6.2% of these households have credit with the bank, but that is 74% of peer. So 25, this bank is 25% lower than peer. Yes, these are a little, if you look at the percentage of households with credit, you can see, probably unsurprisingly, that the penetration goes up as the deposits go down. But this top one is not zero, right? So these are really high capacity households that when they do borrow, they generate outsized loan balances, also very attractive credit criteria, right? As you're thinking about, particularly with an uncertain economic environment, would your chief credit officer prefer, if they had to choose, would they prefer to lend to somebody that already had on average $455,000 with the bank, or $152,000 with the bank, or $78,000 with the bank? Would they prefer to make a loan to that person that didn't already have a loan, or had a lower average balance, compared to somebody off the street new to bank? Now, new to bank's important, right? You got to have continued new to bank. But what this really illustrates is when you think about prioritizing loan growth, there's embedded opportunity that enhances existing relationships. There's also a retention benefit, right? When you make a loan, when you satisfy that credit need for those high deposit households, you are defending the bank the bank is defending relationships that are 78,000, 152,000, $455,000 in balances. So those are really key strategic relationships that have a retention benefit when you make that loan. So that's the intersection of both sides of the balance sheet, right? So bringing together data, putting it together in context with peers. We can dig even further beyond just credit. And then if you look at the bottom of this chart, this is looking at specific granular credit penetration among high deposit households. And so 1.5% of the households have a direct loan, 1.7% have home equity, 5.6% have total credit. Now, if you notice, um, uh, there is, and this is obviously selection. It's not necessarily uh, um, these are not mutually exclusive or additive. So somebody could have overlapping needs, which we'll actually see in a little bit. But you notice in particular, look at home equity. So average balance of $82,000 of high quality balances when they have high depositors. Now, the high depositors, when you think about the home ownership rate of 60% plus, there's a lot of embedded growth opportunity in satisfying those home equity needs within the high deposit households, those households that have higher deposits with the bank. And so that's an example of very granular growth potential. We benchmarked that versus peers, and so this is actually from a different bank, but you can see that the home equity penetration among high deposit is uh, 28% below peers. So there's a 28% growth opportunity to just getting home equity as up to peer average in again of those balances that are very high deposit. We can also look at it even more granularity of uh, the penetration into specific pockets of households. So, for example, what is the home equity penetration in a mortgage households? What is the home equity penetration in checking households? How does that compare to peer? So we can get the whole point is we can get very, very granular understanding what are the pockets, and then with that peer comparison, that provides the context to really say, okay, what are those things that are kind of uh, the low hanging fruit, if you will, or the harder opportunities. And so that kind of insight is really important to having the foundation of this discipline process. Then, of course, what do? We need to act, right? And so when we think about acting, um, we we recommend planning systematically a a program that's based on data. So taking that insight about where are those specific growth opportunities for loans, so whether or not it's home equity or installment or small business, even, what are the specific segments, and reach them through a combination of different marketing channels. And so by reaching out, you're able to drive demand into the customers. And so the planning process is really important. Uh, but not just a calendar. So creating a pro forma to say, okay, if we do these activities that's informed by the systematic data from the opportunity assessment, what should we get? And so in our particular case, we inform our pro forma work by experience running campaigns for hundreds of different institutions. Right. So we're running campaigns based on insight and tracking those results. And so when we calculate a an estimated response rate, number of accounts, average balances. That's informed by what do peer banks see running very similar type of campaigns. And when we track campaigns, we're tracking all the way down the full path to purchase, right? So we're targeting campaigns with specific data-driven attributes. We're generating a targeted awareness through a variety of communication channels, email, display, uh, paid social, OTT, connected TV. So of a variety of ways to reach people where they are. We don't have to rely on them coming into the bank, but we're proactively reaching out. And then we're able to see how engaging those things are through clicks, right? So we are seeing the click activity gives us a good indicator of engagement. It's not the result, it's not the end of the process, but it's a step on that process. We put a lot of weight on purchase response. So how do these people who are reached with based on their capacity propensity, what are the specific accounts open? What are the funded loans that get all the way through your credit criteria? What are they in terms of number of booked loans, balances? And then we know that even past that, as we build the relationship, the retention and growth will be funded up even more. And so um, that's an example of tracking methodology. So systematically saying, okay, what are we targeting? What does work? So for an example of what it looks like, these are real examples. You'll notice with specific banks and different brand standards. So we're big believers in not being cookie cutter, that tailoring the creative to your brand standards. So home equity line of credit. Um, um, we're reaching that message in this brand standard with a specific offer. Business loans, same approach. So we're reaching based on obviously a business use case. Uh, Business lending, another example. So use that. And so when you combine it all together, we talked about wanting to share some specific case studies. When we use the data to identify opportunities, reach people that have a capacity and propensity for need. For example, so we're reaching a homeowner with a homeowner set of solutions. Others, we see results like this. So in this particular case study, the bank saw 331 million in response balances. So this is booked loans again, 41 million in halo balances. So we run campaigns. We see that people open things beyond. If we're promoting loans, they open non-loan products as well as we're driving demand to that sales channels. But we don't count that as a response. And then this particular case, we saw $44 effective cost per account. So uh, the infusion approach is a pay per performance approach. A lot of times our clients will put in place a cap because they still want to have budget certainty. And so when that cap is in place, if the results exceed that cap, the CPA can be even lower because they cap out. That's what happened in this particular case. So it exceeded pro forma, drove that CPA down. Uh, Another client, another bank saw $268 million in response balances. This was a combination of consumer and business, and so the little bit higher effective CPA, just because business owners are a little bit less responsive, of course. And so those are some larger examples. The model is very scalable too. So billion-dollar bank had a little more modest um, loan needs in this particular case. Still really nice balances or 20.6 million response balances, almost 10, more than 10% halo. Uh, and then here, $145 CPA, just because of the differences in scale. And then another more modest approach, 9.4 million in response balances. And then finally, one that was, this approach works pure play with business as well, and sort of a combination of uh, business cross sell and even some business acquisition. Business, of course, standalone, much larger average balances than consumer, lower response rates, and so the CPAs are higher, but the payoff is actually even greater when you look at a payback perspective. And so let's see. I know I'm going quickly. I have not seen any questions come in yet. Let me make sure I'm looking at the right spot. Yep, chat. So anybody have any questions so far? All right. Well, so as we get to the end of our scheduled time to make sure, and so we schedule these for about 30 minutes, assuming we're going to get some questions. But really the key takeaways I would leave you is profitable relationship lending growth starts with a data-driven opportunity assessment. A systematic discipline process is not just possible, but really necessary to drive predictable results. And then your peers are monetizing those targeted loan opportunities. And so Infusion works every day on with banks who may not have the resources or the time internally, or may need some new ideas. But also that banks like the partnership approach because we're putting our money at risk. We're doing the work, putting our money at we're investing literally in your success through the pay performance structure, and so we're setting up these capabilities and helping you monetize those opportunities. And so we would love to help you with those same results. Um, and so if you would like to talk to us, we'll of course send the materials from the webinar out. But if you want to just reach out in the meantime, my contact information is right on the slide. Of course, anyone on the team can help as well. So thank you for your time. We do have some time available. If people have questions, just chat those, and then we will wrap up a little after the half hour if there are no questions. So again, thanks for the time, and we're available uh, for questions. All right, thanks everybody.